As we draw the curtains on the third quarter of 2025, we look at some of the trends that could shape the rest of the year. These are not forecasts, nor are they predictions. Rather, they are more like observations that paint a picture which businesses need to be prepared for as part of their strategic thinking processes. First is the rising geoeconomic fragmentation as trade frictions escalate and the United States attempts a geoeconomic reset, which would be difficult to completely ignore. Second is the trend of de-immigration and scarce talent. Global flow of talent across borders becoming more expensive and complicated. Third is the era of new artificial intelligence entrepreneurs pushing the costs of artificial intelligence assimilation lower and making it user-friendly. And the AI momentum is looking set to spread to other corners of the world. Then, of course, we have mixed signals on the direction of the global economy and heightened fiscal pressures, even as Fed Chair Jerome Powell warns of possible stagflation risks. As this inflation ebbs and most apex banks find a cause to cut rates in Q3, we now see entering Q4 more cautious and data-sensitive central bankers. The US core personal consumption expenditures price index for August came in at 2.9% year-on-year as was expected. Month-on-month, core PCEI also came in as expected. The all items index showed an annual rate of 2.7% as well as a monthly gain of 0.3%, again in line with expectations. The median projection for US core PCEI in 2025 was 3.1% according to the latest Fed Summary of Economic Projections. Hello, this is Global Business Insights, where we examine context in more detail as we probe the main headlines moving business markets and share perspectives on some of the current issues. First, to our deep dive on trends. On the geoeconomic fragmentation, or what some are calling deglobalization or reglobalization, we see old alliances faced with cracks. The United Nations is anything but united, and Bretton Woods institutions are being jolted by a United States administration that now say they are no more useful. We will see BRICS, ASEAN, that's Association of Southeastern Nations, Africa Continental Free Trade Alliance, and all other South alliances gaining some traction, but it did take decades of construction and evolution for the likes of the World Bank, IMF, World Trade Organization to get to where they are today, and they are not going to be so easily replaced. Beyond rhetoric and noble intentions, the alternative ecosystems to Bretton Woods simply are not positioned to step up to the plate. The rise in geopolitical uncertainty continues to fuel market volatility. Fragmentation means many will be revisiting their supply chain strategy, rethinking sourcing and risk, which could entail building more redundancy, holding more stock, which adds up to the cost as countries also play defense with much more protectionism. The China-US divide could also be about to get wider. Still, Trump yesterday signed an executive order approving a proposed deal that could keep TikTok alive in the US. The second trend, and that is the trend of de-immigration. It's not just the United States. All UK adults are soon to be required to have compulsory digital ID cards under new government plans, seen as another way of curbing illegal immigration. Most of Europe, especially Germany, have come under fresh pressures to curb inflow of immigrants. Less immigration will weigh on economic activity as skills become more scarce and expensive. We could see social pressures build up in developing South countries for improved governance as countries are less able to export skills and many return home amid dissatisfaction, which has to be good if it leads to a positive improvement in those countries. Not so good if it leads to social chaos as corrupt and inept leaders underestimate the call for change. Scarce skills, especially in the new digital space, means much more focus required on skills development. Another trend is on the economy and, of course, inflation. The OECD has just raised its global forecasts. We just got yesterday data from the world's largest economy, the US, up in Q2 than previously thought, as GDP rose by 3.8% year on year between April and June, well above the estimate of 3.3%. Also, we got the U.S. Department of Labor release on number of U.S. citizens submitting new applications for unemployment insurance, going down to 218,000 for the week ending September 30, short of initial estimates, and also lower than the previous week, with continuing jobless claims also shrinking. Fed Chair Jerome Powell, in recent remarks, warned that U.S. stock prices appear fairly highly valued and signaled a darkening economic picture, hinting at stagflation. The latest PMIs in Europe are not encouraging. China is still facing what looks at best like an uncertain recovery. Fed Chair Jerome Powell also warned of the two-sided risks, the upside threat to inflation and the downside risk to the labor market, in a recent speech, as divisions in the central bank caused some concern, with the more senior Fed officials going public with their very divergent views on rate cuts. Also, new orders for manufactured durable goods orders went up 2.9% in August. This reading followed the 2.7% decrease recorded in July, coming in better than the market expectation of minus 0.5%. Analysts will be saying that the latest GDP upside surprise, the durable goods data, that's also more positive. Lower unemployment claims could imply a lower likelihood of aggressive Fed rate cuts in the near term. There is a global trend of disinflation, like I said, which may be ebbing as the impact of tariffs and geoeconomic fragmentation takes their toll on costs. Still, Trump's man in the Federal Reserve, Governor Stephen Miran, recently said there is no material evidence of tariff-driven inflation, but that seems to be holding up others on the Fed. In other news on the U.S. economy, Starbucks says it is closing underperforming stores, which could affect 900 jobs. The coffee chain, in a memo sent to employees, say that in some specific locations where they are unable to see a clear path to financial performance, they will have no choice but to close down. You could say that at best, the outlook for the global economy remains mixed, a very shaky amber at best. On the era of new AI, tech entrepreneurs and new technologies, the pace of AI assimilation is expected to pick up as new entrepreneurs emerge. We could also see early stages of dramatic innovation that completely upends the existing competitive landscape dominated by large players. For example, if you look at other areas of technology on quantum computing, HSBC yesterday said it had achieved what it called a Sputnik moment for quantum computing. A pilot deploying a quantum processor built by IBM was said to have yielded a 34% improvement in calculating how likely it is that a bond would trade at a given price. Quantum computers use quantum physics to solve complex problems much faster than traditional computers. Globally, there's a trend of far more investment deals, especially in the high-tech space. Intel is said to have just approached Apple about securing an investment in the financially troubled chip maker after Nvidia injected $5 billion and the US government took a stake. Chip production is becoming the new oil as we get faster transition to digital economy. In summary, the uncertainty remains palpable. The trajectory of the Russia-Ukraine situation is fraught with clouds that could develop into geopolitical and economic storms, and Europe's economy is unprepared for another major continental blowout with an extensive downside contagion. As higher tariffs bite, I suspect a cautious Powell will be proven right as economic growth slows, despite lower interest rates. Companies are much more likely to hold on investment despite the easing until there is better stability on the trade landscape. For Africa, it's an opportunity to look inwards to galvanize capital and talent and monetize the huge potential, getting rid of barriers to cross-border trade and improving ease of doing business. South Africa, Nigeria, Kenya, and Egypt continue to thrive as hubs for tech startups in the continent as more venture capital is attracted to opportunities. Like I usually say, business wants to be prepared for anything and have scenario contingencies ready and also be very watchful of the triggers. To more business stories, Amazon.com is to pay $2.5 billion in fines and reimbursements to Prime subscribers to settle the Federal Trade Commission's claims that it deceived its customers to generate subscriptions. Still a slap on the wrist for an Amazon that rakes in more than that in less than 2 days. Shares of Amazon still closed down 0.94% as traders hardly reacted in a day when the big three indexes were all on track to fall for a third day in a row. So, as many see the S&P 500 as overbought. China plans to cut greenhouse gas emissions by 7 to 10% from 2020 levels before 2035. The world's largest emitter is also expanding its renewable energy capacity. Xi Jinping, in his speech to the United Nations, said the clean energy transition was the trend of our time. The UK Institute of Directors warned that Chancellor Rachel Reeves must increase income tax to sort out the public finances and re-establish credibility in Britain's treasury. The institute says a lot of damage has been done by the government's inability to cut spending, leaving the Chancellor with little choice but to break Labour's manifesto promise not to increase taxes on working people. It may be politically toxic for Starmer if taxes go up again at a time when the latest data points at lingering sluggishness in economic activity. Also in the UK, Peter Kyle, the business secretary, is working on plans to save Jaguar Land Rover JLR suppliers from the brink of bankruptcy after rejecting calls for a furlough scheme. The proposal could entail the government supporting with direct purchase of parts from the suppliers and selling them back to JLR when it starts production. The car maker shut down its 3 UK assembly plants on August 31 after a cyber attack knocked out its systems. South Africa's producer price inflation was at 2.1% year-on-year in August, up from 1.5% in July. Month-on-month, the August producer price index increased by 0.3%. The African Growth Opportunity Act, AGOA, a 25-year-old deal which grants qualifying African nations duty-free access to the US market, is due to expire this month. In an interview on the sidelines of the annual United Nations General Assembly in New York, President William Ruto said on Wednesday that Kenya hopes to sign a trade deal with the United States by year end, at which he will also be pushing Washington for an extension of the duty-free agreement with Africa for at least 5 more years. US stock futures rallied as crucial inflation data came in. The impact of tariffs look delayed more than expected, but we also saw Asian shares lower and European pharma stocks fall after Trump imposed new tariffs of 100% on branded pharmaceutical products imported into America, also announcing levies on several other items, including 25% for lorries and 50% on furniture he claims are all flooding US markets. Shares of US drug manufacturers got a boost. Well, that's it. That's all on this episode of Global Business Insights. This is Bode Oshosani. Thanks for watching. Enjoy the weekend